What is an income statement? An income statement is a financial report that summarizes a company's revenues, expenses, gains, and losses over a specific period of time. It is also known as the profit and loss statement or the statement of revenue and expense. The primary purpose of an income statement is to provide insights into a company's operational performance, efficiency in management, and profitability relative to industry peers. Importance of an income statement. Income statements serve multiple purposes for various stakeholders. Investors use them to assess profitability and make informed investment decisions. Management teams analyze them to evaluate operational efficiency and identify areas for improvement. Creditors review them to gauge a company's ability to generate cash flow for debt repayment. Types of income statements. Income statements can be presented in two main formats. Single-step income statement. This format simplifies calculations by summing total revenues and gains before subtracting total expenses and losses in one step. Multi-step income statement. This more detailed format separates operating revenues and expenses from non-operating items, allowing for a clearer view of different levels of profitability within the business. Key components of an income statement. Revenue. This represents the total amount of money generated by a company from its normal business operations, primarily through the sale of goods and services over a specified period, such as a quarter or year. It represents the gross income before any expenses are deducted and is often referred to as the top line on an income statement. Revenue is categorized as operating revenue. This is derived from a company's core business activities. For example, a retail store earns operating revenue from selling products. Non-operating revenue. This includes income generated from secondary sources that are not part of the primary business operations, such as interest earned on investments or proceeds from asset sales. Importance of revenue in financial analysis. Revenue is a critical metric for assessing a company's financial health and performance. It serves as an indicator for investors and analysts regarding growth potential and operational efficiency. A consistent increase in revenue often correlates with positive market sentiment and can influence stock prices significantly. In summary, revenue is essential for sustaining business operations and funding various activities. Expenses. Any cost incurred by the company to generate revenue and that contributes to a company's overall cost of doing business. This includes all expenditures that are necessary for maintaining normal operations and generating income. According to the accrual principle in accounting, expenses are recognized when they are incurred, not necessarily when they are paid. Two major expense categories are operating expenses. These are costs associated with the core activities of the business, such as salaries, rent, utilities, and cost of goods sold. Non-operating expenses. These include costs that arise from peripheral activities, such as interest expenses or losses from investments. Importance of tracking expenses. Tracking expenses is vital for businesses because it allows them to manage their budgets effectively and ensure profitability. In summary, expenses play a critical role in determining a company's financial health and operational efficiency. Proper management and reporting of these costs enable businesses to make informed decisions regarding budgeting and resource allocation. Gains. Gains refer to the net money made from transactions outside of normal business operations, such as selling long-term assets. Losses. Losses represent costs associated with unusual or one-time events that negatively impact profitability. In summary, an income statement is crucial for understanding a company's financial health over time, revealing insights about its operations, profitability, and overall performance.